Okay, awesome. Welcome to week 4. We're officially stepping into the macroeconomics side or portion of this specific course. This is where we look not only into the individual markets and companies, but ideally developing an understanding of the entire economic system. Instead of asking, is this stock in specific undervalued? Or the emphasis in this specific portion of the class was to get you thinking about what's happening to the economy as a whole. And how will this affect all investments, right? We unpack things like GDP, unemployment, inflation, monetary versus fiscal policy, and how all this ties into the decisions that we make as traders, as investors, and overall the decisions that are made by those in leadership or within positions of power, right? Those that make the official decisions within our government, world government, and our economy here at home. One question that I would love to bring up to you all is what's the key difference between microeconomics and macroeconomics, if you all know? Does anybody have an idea? When we take a look at the micro side of things, and this is just bare bones, right? I don't expect you to have like full in-depth understanding of like a econ 101, econ 102 type of course where you're looking at like micro macro. But micro is individual decisions, if you want to think about it as individual decisions in the markets, whereas macro is the broader economy dealing with things like the growth, the inflation, jobs, national trends, things along those lines. So, a minuscule example of that would be where micro, when you're asking questions within each, micro is asking questions like, why did eggs go up in price? Right? What
So it's
drove?
like the CPI, PPI,
Yeah,
GDP, and stuff like that.
exactly. And then so then that's what those reports, they're giving you a broader understanding of those things in particular, right? So that all of that is still like those specific reports, it's considered or it's included into the macro side of things because the report is giving you a breadth of all of those changes. But micro is looking specifically into what could have spiraled into leading to that change, if that makes sense. So macro is why is inflation rising across the board? Whereas micro is looking at a specific circumstance, a specific um, thing that affected the overall growth. So we're just breaking it into smaller analysis. So when we start to take a look at what we covered through today or this week's lecture, number one was GDP, gross domestic product. This is the cornerstone of any sort of macroeconomics discussion, right? It's been something that from especially COVID closures to now, and give me actually a quick second here. Uh, Optin just asked if we were meeting, so I want to make sure that he's
I
been
was gonna
able
say
to
if
get
anyone
here.
else jumps on, I'll stay in the chat and like shift it
Sweet.
over.
Yeah, that'd be awesome. Optin's in there. We definitely want to host his join. We've let him. Okay. And it might be actually on my end. I think there we go. I didn't pull up the participants. So I'll make sure to have that up and running too. Sweet. Got him in here. Thank you for letting me know. I didn't, I typically have like the waiting room tab pulled up, but I forgot to pull that up. So we're just going through gross domestic product right now. Uh, again, GDP, gross domestic product, it's the total value of everything everything the country produces in a given time frame. So typically it's like a month over month, quarter over quarter type of measurements that we're looking for, or year over year increase. GDP has three main components to it. You have your nominal GDP, not adjusted for inflation. You have your real GDP, which is adjusted for inflation. And this is the one that the markets care the most about. And you have GDP growth rate. So the growth rate is what shows you how fast the economy is expanding or contracting. So this is something that you should pay very close attention to, because as you've probably noticed, there's been times where GDP reports have been released and it comes in higher, right? But the market still runs instead of contracting, or instead of slowing down, or it could be the inverse, right? Where GDP drops a little bit and then the market follows it, or it can be the inverse of that, right? So I bring this up because you never want to um, place your bets, or you never want to say, well, if GDP increases, then it's going to cause the market to retrace. Or if GDP decreases, it's going to cause the market to jump, right? It's all in relation to what the economy, or what society, what our country as a whole is currently experiencing, right? So this goes back to our previous lecture as well, as far as making sure that you're connecting all of these different things together, because they all bounce off of each other, right? They all play a role in how each of these components move, or how the market reacts based off of other factors. So at this point in time, if we were to get, or if you take a look at what happened, and this specific scenario was brought up within the lecture, if I'm not mistaken. If you take a look at like 2022 run, right, where we reached the low at around like October-ish, and then we saw a year and a half nonstop run. And the reason why we were seeing these types of increases was, yet yes, there were times where GDP continued to raise, but it was raising or increasing at around a 1 to like 2% rate, right? So when you take a look at that, it's the understanding that naturally prices and all of these things tend to increase, but at what rate is it increasing? Is it a rate that we aren't able to manage, or is it a rate that shows healthy growth? Right. And dependent on the current status of the economy, there was a point in time where we saw GDP increase. I think, if I'm not mistaken, it was like 11 months in a row, right? So something along those lines. And during that time, that's when the Fed had to increase their rates, right, to offset inflationary concerns. So there's different. What I'm trying to get at is there's different ways you want to approach these reports, depending on what else is going on. What's the Fed doing in relation to these reports? One thing, or something that I'd love to prompt you with, is to think about, why is real GDP potentially more useful than nominal GDP when comparing growth over time? Remember, nominal GDP is not adjusted for inflation, and real GDP does adjust for inflation, which is why it's the one that the market tends to care the most about. So real GDP accounts for it. It accounts for the overall inflation that we're seeing in the country. So it reflects an actual increase in production. And that's something that plays a role in all of this, right? Alongside these rising costs is production of these goods, which we're seeing an overall cost in, is it increasing alongside? Is it decreasing? How do we perceive that? So if nominal GDP rises 5%, but inflation is 3%, do we know what the real GDP is? It's a little bit of a trick question. So remember, real GDP is taking into account inflation, and nominal GDP doesn't. So this is how you calculate the real GDP. Um, if nominal GDP rose 5%, and then we have an inflation rise or increase of 3%, you take away the rise in inflation from the nominal GDP. So in reality, the real GDP only rose 2%. Oh, sorry, I think you're muted.
So, can you hear me now?
Yeah, yeah.
Okay. I was gonna ask, are you suggesting that anytime the nominal GDP, when it reaches any levels 5%, anytime above or below, that's when we should take it as like a trigger to look into the actual cost of the real GDP?
No, no, not necessarily. Well, real GDP is always going to be given to you, right?
Yeah.
But the thing that I want you all to focus on is that because when GDP is released, they throw a bunch of numbers at you. So if you're analyzing it on your own, let's say you are trading, you have your charts open, you're waiting for that report to be released, you're on the Fed's website or wherever you're accessing this report. Once the report releases, it's going to list a bunch of numbers. So this is how and this is for any sort of report. When you get, and we'll go into those when we get to those. Actually, I don't want to like confuse us right now. But when you get the GDP report, it's going to have all of these different numbers, right? It's going to have the nominal GDP. It's going to tell you real GDP. It's going to tell you GDP growth for the most part, right? But when the market starts to read this, right, because we're the market. So when individuals start to read this, we're just going line by line and processing it as fast as we can. So
Right.
that's why when you initially see, right, like a report release, you might
Mhm.
see a move where the candle drops down a lot. Just goes a fat red candle and then
Mhm.
it comes back up, right? And then it starts running up, or the inverse. You get a pop up and then it gets smacked down and then it just bleeds out, right? So those moves happen because that's the market, the institutions, the bots that trade, right? The algorithms that institutional organizations have, they're digesting those numbers. So the initial reaction, it's literally as we go. Let's say that GDP was 5%. And don't mind the percentages, right? It doesn't matter in this scenario. Let's say GDP, nominal GDP is 10%. And we're like, oh man, this is bad. Like we're increasing heavily. So then you get the market drop. It's a big red candle. But then as you're reading the report, you realize, oh, but inflation rose. The nominal GDP is 10%. Inflation is actually inflation is or 10%, inflation is 5%. And then you realize GDP is actually 5%, right? Or it's not the 10% that the market thought. So in that extent, depending on market situations, it could come back up, break even, right? Or even pop up green. So that's what I'm trying to get at is you want to look at the entirety of the numbers and you want to understand within each report, not only GDP, what are the actual numbers that are meaningful, right? What is the market looking for and what's telling you actual market conditions? When it comes to GDP, it's the real GDP, which is accounting for inflation. And I want to say another example, right? That's not a GDP report is earnings report. right? And I want to specifically look into Amazon, which happened on, what was it, Thursday? So I want to bring that up because initially we had gotten a slight pop right after market close, and then all of a sudden it had a huge bleed. And if you're like taking a look at the futures, there was actually like it was pretty crazy. It was like a between like a 30 to 50 point move within like a 10 to 15 minute span. So that's a pretty huge move. And the reason that that happened is because, if I'm not mistaken, Amazon did beat its expected revenue, or it was like right break even. It was right around the number that was expected. I think it might have beat EPS as well. But what happened is that they guided down. So yes, all is good. You beat your earnings that were expected, but they're telling you for the next quarter, we're expecting, and it was a 17% decrease that they guided down. So they literally told us in their earnings report, next quarter, we're expecting a contraction of 17%. So although you're beating earnings now and you get that initial pop, it got smacked back down because they were letting us know this isn't going to stay. These numbers aren't going to increase, or we don't project them to increase next quarter. And even more importantly, when you take a look at Amazon's core business, and this is something that I don't expect you to know yet, but do you know where Amazon really makes their money?
AWS, right?
Exactly. So you definitely you're on top of it. It's AWS, and then when you take a look at that earnings report, so that's their cloud system. That's their online business, right? Because they do have servers that they lease out to other companies, so that they make a lot of money off of their cloud system. And if I'm not mistaken, I'm sure Optin knows a lot more about that side of things than I do. But what I know is that Amazon's the majority of their money comes from that. And if you take a look at the earnings report, they actually reported a loss or a decrease in their AWS revenue. So that scared a lot of the market as well, knowing that that's largely where Amazon's money comes from. So what does that mean for the tech industry as a whole when a lot of these companies are situated very similarly to how Amazon makes their own money. So that's what gave the market a pretty significant scare, right? So that's what I'm trying to get at is that it's important for us to understand not only what is the report and what is the main emphasis or reasoning behind the report, but what numbers are actually important within the report. And those things will change over time, right? Just because right now, for Amazon specifically, AWS is a huge part of it. At some point in the future, they could have a different business model, right? Where what we're looking at is a specific different component. So that is definitely going to be huge for us to develop that understanding of what exactly are we picking out of these, because that's going to give us that advantage or that edge when we're trading these, right? If we are potentially looking to do a news or event back trade, right? If I say, well, I'm going to trade based off of a GDP report, based off of employment report, whatever it might be, we need to understand what are we looking for, right? We're not just going to sit there on the charts and say, well, if the candle goes up, then I'm going to enter a call, or if the candle goes down, I'm going to enter a put, right? We want to understand why the market is reacting a certain way, or even beyond just digesting how it's happening in front of our eyes, developing an understanding of how will the market typically or most likely react if we see it go one way or another, right? So when we're talking about making our money when the markets close, when we're talking about preparing for these things, you can lay yourself out a game plan if you understand current market conditions and current market sentiment. We could very well prepare ourselves to be earnings report traders, to be economic reports traders, where we just say, hey, based off of my understanding, my analysis of current market conditions, if GDP comes in hot, if there is a inflation increase over set percentage, then the market is very likely to take that in a bad way, and we're going to see the market retrace, or the market will probably like it if the inflation rate is fairly low. If we're within a 1 to 3% increase, that's probably going to be digested pretty well. So even when we see that initial red candle, it would be an opportunity for you to enter at the low, right? And wait for that to be digested and play out. So different ways to situate yourself. When we take a look at these other components, a big part of it is the inflation side of things, right? Just moving on. It's been a headline driver for the past few years. Inflation is the rate at which prices increase. It reduces your purchasing power. And that's one of the biggest things that we need to have a real good understanding of, is why does CPI and why do PPI have these sort of reactions? It is because it's either reducing, increasing, it's impacting your overall purchasing power, meaning that your money is potentially buying less over time. Right. So CPI is the consumer price index. It's the broad measure. Core CPI includes volatile items like food and energy, right? So this is another report where you get multiple components, where you have the broad CPI, you have core CPI, and that's what we saw a huge focus on the past like 5 or so years now, because what have been the components that have been really stressed or have faced a lot of where we as individuals have faced a lot of trouble in regards to like our economy, like in our day-to-day lives. Yeah,
Yeah, what
food,
was
right? So
oh,
so um what have we as a society seen a lot of struggle with, as far as like our day-to-day items, things that we need on a daily basis that have been increasing in price.
have commodities. I mean, eggs alone.
Yeah, eggs alone for sure. Yeah, so we got food, we got the price of gas, right? I don't think we're going back to what we were paying pre like 2019 or even like early 2010s. It's very hard to see ourselves going back to those prices. Housing has been a really huge one, right? A lot of people unfortunately are being displaced. It's caused a lot of people to not be able to live on their own, right? Just living paycheck to paycheck. I say this, I just recently at the institution that I work at on Thursday, actually, we just had this research conference, and I was really interested in a specific one. And this was it's a research conference between our business department and our language department. So this was predominantly looking at like Spanish speaking countries, Latin America, European Spanish speaking countries, and one specific student focused on the displacement due to the tourism industry, right? Tourism industry, or the fact that a lot of individuals can no longer afford to live here in the States or in Canada, or even in Europe alone. So you see this migration into Latin America, or even places like Spain, where the cost of living is a lot more affordable than it is here in the States, in certain areas, of course, right? And the fact that because of like the Airbnb system and things like that, it crowds housing. So now it's really hard for individuals across the world, not only here in the States, but across the world to be able to find affordable housing. And a lot of more people are living in multi-generational homes, right? Whether it's with our parents, extended family, our grandparents, things like that, because that's how we're able to make it work. It's really hard at this point in time to just live on your own with one paycheck, right? If you're living with like a significant other or at least one other individual, two paychecks make it a little bit more affordable, but you're also not having your traditional like American dream home, right? You're probably living in a reduced space to make it more cost effective for the most part, just generalizing, right? What a lot of people are experiencing in the country and abroad today. So these are all things that we have seen or foreshadowed is what I want to get at. We saw this being foreshadowed within our CPI, the fact that these numbers just kept increasing and increasing. And to an extent, you also want to understand that a lot of this data it's delayed, right? So a lot of the data that we're getting, it's from the month prior. So that's why I say it's delayed, but it foreshadows because if you think about, well, if this data, whether it was GDP, whether it's the CPI and the PPI, it's telling me what's released this month or this quarter. It's all the data that was collected in the previous month or the previous quarter, right? It's not telling me what's happening right here now today as the market's being traded. So then it gives you the opportunity to say, well, if I've seen CPI, or if I've seen, let's say GDP reports being released first. If I see, well, GDP's been rising 11 months in a row, or it's been rising 3 months in a row, right? If we take into consideration that time frame where it was increasing 11 months in a row, if we're at the fourth month and we've seen 3 months increase, and we're analyzing that current market and we're getting ready for a CPI report, knowing that it's increased, GDP has increased 3 months in a row, odds are that CPI is going to see another increase, right? So this is where we start blending all of these reports together as far as making our best educated guess or building a plan for ourselves and understanding where is the economy heading? What are all these different components that play a role in these increases or decreases? And how can you make a solid hypothesis, right? That's what you're doing. And so I want you to really take those trends into consideration because that's how you'll best position yourself. And that's, I think, what a lot of people don't realize because a lot of people wait until the report's released and they say, I'm going to react in relation to how the report is released, right? But if you're thinking about if you want to mirror how you trade your chart, or at least how I do, right? How I set myself up, how I trade my chart. And if I want to mirror that to the reports, it's the same thing, right? And when we talked about charting during our charting session, I let you all know I chart my weekly levels, I chart my 4 hour levels, and then I trade or I execute off of the 15-minute chart and off of the 5-minute chart. So I have my support resistance levels, I have my supply and demand zones, and I watch the chart. I'm not going to react right away, right? I'm looking for patterns to build up. I'm looking for price action to reach those levels that I outlined. And then based off of what it does when it's reaching those, if it's support, is it bouncing off of it? Am I seeing volume increase or spike as a buyer volume as it's hitting that lower level? If it's running to the upside, am I seeing seller volume rise, right? So is volume dying off overall? And is it potentially rejecting, right? These are the things that I'm thinking about. So I'm going to execute based off of how price action reacts to my setup, to my levels, to my zones, and the patterns that I'm seeing built. Very similarly, when I'm taking a look at all of these reports, whether it's GDP, whether it's CPI, whether it's PPI, whether it's job reports, all of these things, I already have it. I'm already building an understanding of what is the market currently experiencing, where is our economy experiencing some pits, right? Where are we seeing this being stressed? Where can we potentially fail? Where can we potentially see an increase? So building all of these different scenarios. So when the report is released, then you have an understanding of like, okay, this is what the market was looking for, or this is not what the market wanted to see. And I guarantee you, if you start building that understanding for you, and you don't have to trade it, right? Just watch it and tell yourself, I think if CPI comes in high, then this is going to happen. Or I think if CPI comes under, this is what's going to happen. Or I think that if PPI comes within this range, this is going to happen. And then just see how it plays out, right? And more often than not, if you're able to build that solid understanding, you're going to be right because you're understanding what's moving the market or the sentiment of it. But you won't always will be. And I say this because you, again, have to take into consideration these other stressors that are going on or happening within the economy and our government. So I say this because we when was this? I think it was 2 months ago when PPI came out. So that's the producer price index. It gives us an understanding of production rates and things along those lines. So I think what had happened at that time is we got an increase. It was like a slight increase, if I'm not mistaken. And we thought that the economy was maybe running a little bit hot, but the market completely ignored it. Right. We got like a slight reaction at first. We got a little dip. It lasted maybe like 2 minutes and then it came right back up and then it ran the rest of the day. And the reason why that happened was because it was when our current administration said that they were going to pause the tariffs, right? So you have to take into consideration the entirety of what's going on, because yes, that report is signaling something to us, but there's other things that are manipulating or that are moving the market in one way or another. So based off of what's going on, as we see these reports released, they're going to potentially react in different ways. So that's why you want to see the entire picture of what's going on. Okay. One question for you all. What happens to your savings? And this is, I think, pretty basic, but what happens to your savings if inflation rises, but interest rates stay the same? So if you're looking at like your typical savings account,
Wouldn't it lose value?
100%. Right. So you're losing your purchasing power. The real value of your savings over time is going down. For example, if you have $10,000 in an account with about a 1% interest rate and inflation is at 3%, it's being offset or you're losing 2% value, right? Because you're only gaining 1%. So that's definitely something that I've developed a really good understanding as far as where could I potentially store money, right? If I'm saving, what are different vehicles that that would help me make best use of how I save my money. And that's a big reason why I haven't necessarily save or put like the majority of my money in like a traditional savings account. That's why I've felt more comfortable expanding my long term, looking into some other, I guess you could call like non-traditional, right, areas to put money. If you take a look at a period in time, TLT, do you all remember what TLT is?
Bonds?
Yeah, it's the bond ETF, right? So if you take a look at TLT, functions like a bond, right? Remember, bonds are contracts where whether it's a government bond or a specific company's bond, where they're letting you know if you let us borrow your money, so if you put up X amount of money, we're going to give you a certain percentage back. And that's a contract, no matter what, you're getting that percentage back, right? So at a certain point in time, where I think my bank it was literally under like 1% interest rate. So at that point in time, I felt more comfortable saying, well, maybe I'll put these $2,000, $3,000 in TLT, or these bonds that could potentially give me like 3%, 2%, right? So there's different vehicles out there that we covered last week, that could help you mitigate some of those, and they won't always be at those rates. They do fluctuate, so you have to actively keep track of where do those potential opportunities lie.
You could also use tips, correct?
Mm, yes, yeah,
Yeah.
that definitely. So like definitely, thank you for bringing that up. That, like we said, there's a wide variety of opportunities out there, and I think that the typical like investor individual that's just looking to find a place where my money feels safe, a lot of the times you don't take like the extra step to realize I'm actually losing here. So there's opportunities or ways to potentially mitigate that. Cool. And we can take a look at interest rates. Yeah, we dove into that. Hmm. Okay. We can also, or we should also keep in mind employment rates, right? Unemployment reports. This is more than just a number. It tells us how healthy the job market is and how secure, more importantly, right, the latter part of this, how secure a consumer feels. Do are you all familiar with with consumer sentiment? Awesome. Consumer sentiment has been a pretty popular report, and it's, if I'm not mistaken, done through the University of Michigan, right? That's who oversees the consumer sentiment report. And that was one of the reports as well, where, if I'm not mistaken, consumer sentiment like had plummeted, and it also happened during the tariffs, the tariff news as far as pausing tariffs. And typically when you see the consumer literally tell the market, we don't feel comfortable buying, right? My savings are being depleted. I can't buy as much. I don't think I'm going to go out and buy luxury goods. I'm not going to buy a new car. I'm not going to spend money. That's a huge report, because if you take a look at the basics of how the economy works, which is, it's one of the videos that I'm working on to release in the next like week or so, and it's touched on in one of last week's readings. If you want to take the time to read any book in depth in the next like week or month or so, I really, really encourage you to read Ray Dalio's Changing World Order. It literally walks you through the rise and fall of every single global power, right? Like the Roman Empire, how the Dutch started the markets. It walks you through the rise of the states, and what we're currently experiencing. So it's basically the expansion, the contraction of every single world power that has ever existed. And this specific book also does a deep dive into, or if I'm not, that book, or he has another one too, but I'll go ahead and provide all that. Specifically covers how the economy works, and at its bare bones, it's supply and demand, right? It's people buying and people selling. So whenever you see consumer sentiment, or the consumer say, I'm not thinking about buying, or I'm gonna not necessarily put money in the market, that's a clog in the system, right? Because there is no money, or there's less money being moved around. So that's why a lot of people emphasize or pay very close attention to consumer sentiment. But last report, although it did decrease, the market still ran because we had a pause in tariffs, right? So it won't always act, or we won't always get the reaction that we anticipate. But knowing that, moving forward, you see why the market, although it ran, why it dropped and why it took us so long to potentially get back up, because that is still an underlying issue, right? That there isn't as much money revolving, right? And we've been seeing this since about 2021, 2022, where yes, the market kept running, but what has always concerned me is that the market has been running with less volume. So there's been a toll, like when you take a look at the amount of people, the amount of money that was being moved around during us receiving the stimulus payments, it was huge in comparison to what we're seeing today. So in my mind, it's very hard to make sense of running up back up to all-time highs when we don't have as many people in the market. We don't have as much money in the market. So that's always been something very interesting to me. And that's why, to my understanding, why we see these huge movements and why there's times where we see a huge drop, and how the retracement between reaching all-time highs and the new administration being voted in, right? Because we ran up at the mid to late November, and then we started to see a huge spill. Or a pretty significant retracement where we were nearing a technical bear market, and it happened in such a quick or short amount of time. And that to me happens because there aren't as many people, or there isn't as much money to support those market movements, or to say, hey, we're stable here. Um, so back to the unemployment report, one of the biggest things that keeps the economy propped up is us having employment, right? Because if everybody in our society, in our government, specifically in our country, is employed, and we're earning, if our wages, if our minimum wage or the median wages are increasing year over year, what it means, at least on paper, is that we have more money to spend. So it justifies inflation going up, and it justifies prices of the market going up. So naturally, if you have that understanding, what do you need for the economy to reset? And if you take a look at cycles, right? Because cycles happen, and they're bound to happen. You can't get away from these cycles. So historically, if we need to see the market drop, if we need to see interest rates drop, and why haven't we seen interest rates drop? What do we need to happen?
Yeah, employment rate,
We need people to be unemployed.
right?
As far as that, as like as bad as that sounds, that's the reality of it. And that's why a lot of people, since the new administration being voted in, have had that fear, have said, hey, we're going to go into a depression, or it's going to be a hard landing. It's that understanding that we've reached a point in our cycle that we're so overextended that what else can what can the current administration do to lower rates? Like, we're not going to low we tech on a technicality, rates cannot be lowered a significant amount or enough for us to feel comfortable if we as a whole are continuing to gain bigger wages. It's
And
very
so,
hard to do.
so unemployment is also like moving with and associated with like lower inflation.
Correct. It is. It goes hand in hand. But of course, the whole point of the Fed, or what they're trying to do, is to balance that out, right? So that's why you've seen you saw a sharp decrease since the new administration got voted in, but it's artificially managed, right? That's why you get the Fed printing money. They stop. They do all of these things to mitigate it, right? We covered some of that during the past week or two. So their whole goal is to mitigate it and have a gradual decrease over time. As you've seen in the past 2, 3 years now, that there's been a good amount of layoffs within the tech industry specifically. If we take a look at the education sector, there's been a pretty substantial amount of layoffs within government jobs. The current administration has laid off a lot of people, right? One of the very first things that the current administration did when they started their first 100 days was to. Do you all remember what one of the main focuses was? To cut wasteful spending, right, within government itself. So they got rid of a bunch of different departments that they didn't see a need for, or that they said we're putting money into this and it doesn't make sense, or we're overextending ourselves in certain areas. We've seen a lot of grants be revoked or removed. So free money that's given to organizations, whether it's helping like underserved communities or whatever sort of thing was going on. A lot of those have been taken back. So cutting wasteful government spending is one of the reasons that they say that a lot of these job cuts were happening. So it all starts in government, right? It all starts in Washington, D.C., because what happens if you completely get rid of the Department of Education?
No more schools?
Not necessarily, but it spirals. So the Department of Education, it's a government department,
Gonna
right?
say it almost trickles down, right? Like that's just like a kind of starting point.
100%. That's exactly what happened. So it all starts in Washington, D.C. So that's why I've paid very close attention to all of these administration policy changes and things along those lines, what departments are being cut, because it all trickles down. So if you right now, one of the biggest talks is getting rid of the Department of Education, right? So what that happens is let's take a look. I don't know exactly how many individuals they employ. How many, let's take a look at that. How many individuals does the Department of Education employ? Let's see if that's given to us. So within the Department of Ed, within the government itself, DC, they employ about 4,209 people. If you fire all of those people in comparison to the entirety of our country here, it's minuscule, right? It's very small. But what happens when you get rid of a department like that? That department funds every single state, right? So then it trickles down to the states because the Department of Education funds local school districts, and those local school districts play a role in the students that they're getting through the K through 12 system, and that they then see move on to the college university level, right? Whether it's community college, a 4-year institution, that whole track. So when you cut the Department of Education, it trickles down all the way through your K to 12 education. You're cutting potentially things like your Pell Grant, your financial need grants that you get for going to college. Here in California, I don't know if you all are aware, but we have something called the Promise Grant. The Promise Grant gives students all throughout California, if you're a resident, it lets you complete 2 full free years of community college. So that's essentially half of your degree if you're a California resident. So I know that in large part, yes, that specific grant is funded by the state of California, but they also use some of the government Department of Education funds, and that those definitely do play a role in that, right? So how does it impact that? How does it impact the amount of graduating high school seniors that are then moving on to college to hopefully obtain a higher skilled position, or to obtain knowledge that's going to help them move their family out of poverty, or to move within social classes, things along those lines, right? Or even beyond the personal context, how is it potentially then going to impact our workforce? Right? It might decrease it or it might slow it down, because people, when you don't have that stimulus as far as grant opportunities that minimize your cost of education, it's going to take you longer to get through it, right? So for a student that might have been able to get through it in those 4 years, well, what am I going to do? I'm going to split it up into payments that are manageable for me. So I might end up taking 5 to 6 years, right? So the overall employment, the workforce, it's going to shrink, it contracts, it slows down. So these are all things that they're very well aware of. So for instance, let's see, they is something that's not affected me personally, but I think I mentioned it to you all before. For instance, my fiance, she is in the biomed world. She does cancer research, right? As a PhD student, a lot of your funding, like your tuition costs, your school costs, when you're in the sciences, a lot of it is covered by the school itself, right? But when you're doing research work, when you have to buy the equipment that you're working with, when you have to buy the organisms, so the cells, or if you're working with animals, whatever it might be, all of the why is the word escaping my mind? But all of like the pharmaceuticals, the drugs, the chemicals, whatever you're working with in whatever type of research setting, all of those you need to buy, right? And when the school covers it, they're typically covering just your tuition and the fees of the cost of getting your education. They're not necessarily covering the cost of your research work. So a lot of these individuals finding themselves in those settings, what they do is that they look for grants to fund all of those extra costs. One of the biggest organizations that a lot of these medical or health and life sciences researchers at that level look to is the NIH, or I'm pretty sure it's the NIH or the, yeah, National Institute of Health. I couldn't remember if it's NIH or NHI, but I'm almost certain it's NIH. So they look to them, right? They're a government funded organization, right? So if you take a look at what happened early on in the administrative change, they cut a lot of the NIH funding. They cut specifically funding for grants that were going towards, for instance, there's some grants that are specifically stating the criteria for it. You're a PhD student, you're within this field, and you're specifically a minority student, or you're coming from an underserved background, or you're a first generation student, whatever it might be, right? So I know that early on there was a lot of discussion about um, why are we awarding money to people that might not necessarily have the merit, right? So we're shifting over to an idea where we should be giving money to people based off of merit and not necessarily based off of their background, right? If they're a minority individual, if they're a first generation college student, things along those lines. So I bring this up because I understand the merit side of things, but when you're undergoing things like this and there's a shift, then it causes a halt in research, right? And I mean, I've gone to, not again firsthand, but secondhand, seen this where she had been awarded a specific grant for a total of 4 years that was specifically for first generation college students because that pertains to her. So that being cut off, then it's kind of the rush to, well, how am I going to pay for next month's supply of cells and, organisms that I'm working with specifically, and having to figure all of that out. It does impact people, right? So now her graduation time frame is backed up another year because instead of doing the work right now, she has to devote an entire semester to finding the funding to do the work. Right. So these are just very particular examples, the Department of Ed and the NIH, where all of this trickles down and it leads to unemployment. It leads to a decrease in the rate of people being employed.
So I think you're saying it sounds like her graduation is almost on pause because they cut, the budget for NIH, and I guess some of her research funding was impacted. And unless she
Yes.
could find someone to fund the research, she's kind of stuck in limbo.
Unfortunately, but also fortunately, her so every student is also given a PI, right? It's your mentor, faculty member within the institution. Fortunately, her faculty member is really entrenched, like she's really well known within the field of education. So they've been able to mitigate a good amount of that. She doesn't have her full funding, but she was able to secure some partial funding. So she won't be completely slowed down, but there was one semester where she did get backed up because her time frame was to graduate initially this past December. But now she's not graduating until next December, right? So it did slow her down a semester, and technically she could aim for like at the end of this summer, but she's also that additional partial funding that she's working through. She doesn't know how soon she'll get it. So in her mind right now, it's going to be until next winter or even the following spring. But yeah, that's definitely an unfortunate situation that I've seen like in my personal life play out. And I felt comfortable bringing this up because to me that's how I'm piecing all of these things together, right? You have to look around you and develop an understanding of how are these things that we're seeing on a computer screen that we hear on the news, how are they actually impacting us in our day-to-day lives? Because it's very real, as removed as it might seem, right? Where you see, well, the government's firing government officials, or they're firing or getting rid of government departments, so it's not necessarily directed to me. It will trickle down to us in one way or another.
Yeah, we've
Yeah,
been
I think
affected a lot by the national parks going through the same thing. It's been really, really massive, especially the just insane amount of layoffs. And but yeah, very similar. Like it's trickling down to projects that you wouldn't even assume that would be attached to it, but
Uh,
it's affecting all of it.
oh yeah.
Yeah, Rios.
Yes.
So I do have a question going back to the unemployment part.
Mhm.
Just real quickly, you know how uh, the feds, when they raise or cut their rates, given that there are these economic indicators, would you say that the feds they weigh heavily more so on the unemployment rates compared to the other indicators, or do they rely on a different kind of indicator?
Oh, they're mainly not heavily on unemployment rates. That could potentially play. It could be a factor of it, but what they're mainly looking at are GDP and core CPI,
Okay,
because
that's
those
me.
are the though I would look at unemployment as a direct factor or outcome of GDP and
Okay.
CPI and how those work together. Because unemployment is again more of that trickling down, right? So that's why we've been covering all of these components because they all kind of go hand in hand or feed off of each other. But in large part, it's you're looking at CPI, so the overall inflation, costs of goods, and because unemployment uh, is how do I want to say this? The unemployment or even increase in jobs, it would play a role in, let's say, oh man, I don't remember what month or what year this was, but I remember trading into this. But there was a specific year and month. I'll have to look back and see when it happened. But we had it was during that 11 month, the month over month continued increase in core CPI, where we got a slight increase. The CPI increase was very minimal, but then what we saw, what we saw after that, when we had unemployment rates or jobs report Not it's not an unemployment report, it's a jobs report. When that got released, it increased significantly. So it showed that wages were still increasing. So that caused, although we said, well, GDP, CPI, it's very minimal. It caused the Fed to have to or feel the need to decrease or what was it? Sorry, was it increase rates to continue to increase it to offset that inflation that they were that they were projecting, because they're saying, well, this jobs report came very strong, so we're not seeing this go down. So next month the CPI could be a lot more than it is currently if these people keep getting bigger wages and spending more money.
Sounds
So
like
at that point,
2023.
it was around there. I forget exactly, but I'll have to look back. I literally I have a notebook with a bunch of notes like over time saying like this is what
Yeah.
happened when. So I just love to keep track of things like that. Um, so looking at like the overall macro side of things, but that's one specific moment where I remembered it play out that way, where jobs report did have like a huge impact in it. So like I said, it really depends on whatever specific circumstances we find ourselves in. So that's what we want to develop the understanding of, what's the market looking for, and as these reports are being released, how can other reports, how can other factors potentially play a role in the other data or what we're seeing as a whole, because they're all a piece of the puzzle, right? Or the piece of the bigger pie. Awesome questions. And the one thing that I want to, moving forward, another thing that I want to emphasize within the business cycle itself is that this is looking at the business cycle, not necessarily the market trend cycle, right? Because you have, these are two different things, but they can potentially go hand in hand. So this isn't the business cycle listed here. It's not necessarily the Wyckoff cycle that you see within your charts. This is the actual cycle of a business, of an organization, its growth, its expansion, its contraction, its consolidation. So this is specifically looking at the growth and potential fall of a company and how it works. So it walks you through each phase of those and the different effects, or what you see increasing as companies go through this cycle, and how it potentially plays a role in those different reports that we talked about, right? So when we're taking a look then at what spirals into an increasing GDP, unemployment, consumer spending, and all of these things, this breaks it down to you in a general sense, right? Because again, these things might differ in different market conditions, but typically when you're seeing a company go through expansion, especially if it's one of our big players like Microsoft, Apple, Amazon, all of these, Meta, all of these big players, the reason why we take a look at earnings report and why we want to develop an understanding of the health of a company is because if we understand the company to be undergoing an expansion phase, right? For instance, what happened with Meta back in 2022, you could say at that point, Meta, or I think it was still Facebook, the market believed it, and I want to use this exact example because it wasn't a growing company, right? The market believed it to have reached its peak in the sense that it touched almost every single person around the world, right? It was the one social media platform with the largest amount of active individuals on their platform. So that gave them the largest pool of data to collect, metrics to go off of. So it reached a point where their earnings report, quarter over quarter, it was reaching a peak, right? Like, where else do you go? How do you make more money than this when you're already in every single home, you're already in every single person's phone, right? So what else can you do? So we thought it reached a peak. It started to decline. This was around where the market as a whole was dropping in 2022. And then what happened? What was one of the biggest factors that caused the rebound and had Facebook run for about a year and a half and reach new all-time highs? Do you all remember?
This is Microsoft we're talking about?
No, Facebook, Meta.
Nope, that's beyond it.
It's changed to Meta.
Oh, since
It's the change. So if you take a look at when they announced that they were changing their name to their ticker symbol to Meta, as silly as it sounds, they also had a conference or like a meeting to back why they were changing their ticker to Meta. So it was the shift in focus from just being a social media advertising data platform to dipping their toes into the VR AI side of things, right? So at that point in time is when we were seeing the AI or the field of AI actually become more of a sector or an industry in itself, right? So that's when we started to see the big run in AMD, Nvidia, and that's when Square became Block, right? In addition to all of this, the cryptocurrency runs and all of that. It happened during that time, and that's why we started that to see that bounce. So Meta it's a picture perfect example of how an established company could potentially still undergo an expansion phase. So if you needed to continue to grow, what do? You open up an AI specific department. You open up a department focused on VR, right? They had already, I think at that point they already owned Oculus, the VR headset company, but it was how do we expand this project? How do we get into this new field or this new potential growing sector area of interest? So when you see these sort of expansions in a general sense, or typically, while companies or the market's going in expansion phase, you're getting an increase in GDP. Unemployment is falling, right? Because from late 2022 or October 2022 and on, Facebook was hiring more individuals because they were opening up new departments. They needed a larger workforce to focus on growing the company or moving the company in this specific direction. So there you get an increase in corporate earnings. Your interest rates are at this time they were moderate, right? We started to see kind of like a stabilization or an attempt to stabilize those. So definitely a great example of a potential expansion phase. I think that currently across the board, we're looking at companies reach peaks again, right? Because I think we've overextended or we've hit a point where we're as a market, as individuals kind of realizing, well, where is AI taking us? And we've seen all of these companies say AI, VR, crypto, all of these things. But what are they actually doing with it, right? Are we now seeing the product of all of this money, all of these efforts that were poured into it? Yes, we have seen things change drastically, but I don't think we've seen things move in the way that the market expected them to move. So when you start to see businesses hit a peak, that's when you're hitting full capacity, right? You don't know where you can get more money. Where can you get more subscribers? How can you do all of these things to increase your profits? So this is when inflation again is starting to hit those peaks. You start to see or feel that stock prices are potentially overextended. Within the charts, you're seeing higher lows. You're leading into a potential contraction phase or recession. That's what we're kind of in the midst of right now. We're between peak and contraction, where the market is figuring out, are we overextended or is this just a consolidation, right? That's what we're focused on when we're taking a look at the Wyckoff cycles is this going to lead into contraction, or are we just consolidating? How are tariffs going to affect the economy? Is it true that tariffs are going to bring more wealth back into the States, because if it does, then all this is a consolidation phase. And then we're going to see another boom cycle where we reach new highs, or if we fail to stabilize the economy, if we continue to incur additional national debt, then it's going to be a recession. There's no like ifs and buts about it. It's either going to be a boom or bust, right? So definitely big things that I'm keeping in mind. Do we all know what kind of investments tend to perform better during a potential recession cycle or phase?
Value stocks.
Yeah, could you give some of those examples?
I think triple M is one of them.
Yeah, it could be one of them. Definitely anything within when you're taking a look at those values, it comes from healthcare, it comes from utilities, it comes from consumer staples. So those traditional companies that have vertical integration, right? As far as the companies that can mitigate any sort of loss. And I say this, for instance, why is McDonald's considered a consumer staple?
I would have thought for the low price point, but I've heard it's gone up since then.
Yes, yeah, it definitely has gone up right alongside everything. But the reason why McDonald's as a company is considered a consumer staple is that it doesn't hold its wealth in the sales that they make.
Real
This
estate.
is Exactly. So
Yeah.
it's very similar to, remember we talked about the airlines and the airlines' wealth actually being held in their routes and the rights of those routes. For McDonald's, it's the real estate, because McDonald's owns every single piece of property, every single piece of land, every building where their stores are set up. So McDonald's wealth is mitigated in the real estate side of things. For them, the sales that they make, that's kind of like, if you're taking a look at you being a landlord, your profits would be in the rent, right? So for them, the sales that they make is like the equivalent of the rent if they were renting out those facilities. That's how their wealth is mitigated by the real estate. So that's why it's considered a consumer staple, because they can only lose so much. The real estate's always to an extent going to hold some value. So for McDonald's to crash to go to zero, the real estate market would have to crash alongside the stock market, alongside their overall sales. And a lot of the companies and consumer staples and these value stocks, they're vertically integrated. So what that means is that they not only own the business itself, but they own the real estate, they own the suppliers, right? McDonald's, I don't know McDonald's specifically, but some companies, they own their own trucking side of things, right? They own their own way to transport their goods. They own their own airplanes, things along these lines. So that's what it means when you're vertically integrated, that you have a hand in every single part of the process in making your business run. All righty. So we covered these phases. Yeah,
Also in recession and stuff, I was loading up on my like dividend ETFs and stuff like that too. Try to pump those out.
definitely. It's a huge thing to have, especially when they're legacy dividends, right? When you know they have a strong history. And you can find every single company will literally have a list of all of the dividends they've given back to when the company started giving dividends. So what I like to do sometimes is taking a look back at historical points and looking at what they did with their dividend payouts during those recessionary periods and things along those lines. It gives you more confidence in holding your money there, right? And making sure that there's still some sort of accumulation going on. So that's a big point to bring up.
While we're invested in those dividends, you know how Okay, in your case, Rios, if you're hanging on to these dividend stocks, what makes you think twice about selling these dividends if you see that these dividends are being cut?
If the dividends are being cut, you want to take a look. And that's a great question. I'll go ahead and bring up some resources later today in the Discord as far as what makes it still a value, right? When you're taking a look at for instance, like PE ratios, so price earning ratios and things like that, and how that plays a role in dividend payouts, or how the company determines what sort of dividend they're going to give out, and also in relation to their historical dividend payouts, because they will fluctuate. So ultimately, you want to make sure that you have a good yield. So there's a specific formula to analyze what yield you're getting. So based off of the price you pay and the actual dividend payout, it all comes down to what are you comfortable with, or what kind of yield you're looking for, right? So I say this because, for instance, a good example, at least for me, what I think based off of your question, is a dividend payer that I had that isn't considered like a, what's it called, a dividend aristocrat. I think that's the term that it's called. But I bought into about like 2 years ago. I bought into oh, why am I forgetting the ticker name? Give me a second here. I'm gonna pull it up out of the long-term build. I have a document with all the holdings that I have and that I had. Need to
Yeah, my uncle works for Cat, and he has a lot of his.
Nice.
I know they're one of the biggest ones.
They are. But mine was the oh yeah, Beto. So yeah, the Bitcoin ETF. So if you
Uh-huh.
take a look at that, and the reason why I was interested in investing in them is because of the dividend. And then at that time we were seeing that increase in crypto before it, as it led into 100K, right? So I got in before Bitcoin had reached 100K, but Beto it's the first the first Bitcoin ETF that hit the market. So it has been around for a couple years now. But when I first entered it, I think it was around like 15, $16 per share, something like that. I ended up my initial investment with around like I entered, or over time I put in around like $1,200. That's what I put in myself. When I first started, the dividend for that was 39 cents per share. So the yield was all right. It was pretty good, but within 6 months of holding it, the yield increased to $1 per share. So I was getting a good amount. So I got to the
Pretty
point
fast
where,
turnaround.
Yep.
yes, because because it's directly correlated to Bitcoin's price, right? So that specific ETF, it fluctuates based off of Bitcoin's price. So for, I kid you not, for a year and a half, that dividend payout every single month, it kept increasing. And within the first 6 months, it increased to a dollar, and then it increased a little bit more than the dollar for the whole like next year that I held it. So I got to the point where I was actually in dividend payments making back around like 1.5 shares. And I was just snapping up a share every single time that I was getting a dividend payment, right? And I was adding a little bit on my end over time. So it was really for me, it was a great experience. And I think I ended up total getting being able to, every single time I was getting a dividend payment, I was actually getting back around like 4 to 5 shares of it, which is crazy when you think about like dividend payments
Jeez.
itself. Yeah, it was insane. And I actually ended up right about almost doubling my like initial position in Beto over that time. But then what happened when Bitcoin retraced? They started to cut that dividend payment. So as I saw my share price overall start to decrease, they started to cut it. So I actually sold off because I saw, okay, this is overextended based off this cycle. I think it's going to, I need to find some stabilization. So after 2 months, month over month, seeing a cut in the dividend, I actually sold off my position with the intent to buy back in once I see things stabilize. And it went from that, I think it reached a high, I started to reach a high of like $1.30 or something like that per share dividend when it broke 100K per Bitcoin, right? When price broke that. When I cut it, it was right around like 89 cents or something like that. So I saw it decrease about 10 to 15 cents for the each of those 2 months. And right now, or last time I checked, it was actually under 39-cent dividend. So back to around like where I had initially bought in, right? So I bring this specific example up to you because I felt comfortable getting rid of that because of that specific situation and the fact that it's a volatile ETF and it's a volatile dividend payment because historically they haven't been at that high payment, right? It'll just keep fluctuating alongside price. But if you're taking a look at like the example that Mitch brought up, the cat, that's really stable, right? When you take a look at examples like Procter and Gamble, even Triple M, right? All of these potentially are more stable. So that brings a lot more confidence in saying, well, even if the share price keeps fluctuating, if we see some sort of retracement, the dividend's going to technically, or for the most part, be pretty stable. I'm not going to get that dividend cut in half or in 2/3 of what I am earning currently. So to that
So,
extent, mhm.
sorry, Rose. So in your
No,
case, if you're looking at these value stocks you're invested in as part of your long-term portfolio, what exactly is the first thing that you look at in determining either if you have to cut some weight behind the value stocks?
yeah, when I'm looking at and good timing because right now that's what I'm working on is figuring out what are the potential investment opportunities because like I stated, I sold off a lot of my portfolio early on this past quarter and we technically we're in May. We already ended the quarter, right? So now what are we looking at? We're looking at a reset across sectors. And that's why we saw a lot of fluctuation happening this past week, because not only was it earnings report, but earnings report at the quarters are very, very drastic in giving an indication of where institutional investors might shift because of those earnings or where they're seeing the quarter wrap up because we see sector rotations. We haven't gone into those. We'll get into those next week. But getting a little bit ahead of ourselves, sector rotation, so things like that. So what I'm looking for as I update my ETF guides and all of these things, as I put together my monthly sector breakdowns, I'm looking specifically in where I find the biggest value in finding the beaten down companies, right? So I haven't done a full breakdown just yet. So off the top of my head, I don't have specific examples, but just to give you like a rough example, it's not necessarily a value stock, but it's a stock that it's a financial tech stock, PayPal. And the reason why I've been looking at that is because it's been heavily beat down, but it had earnings report coming up. The financial sector has been pretty stable or it's seen some growth and potentially looking into, well, is there a rotation going into financials? Is it going out of it? How is the tech side of things related to that? So what I'm looking at across the board, no matter whether it's a value stock, a growth stock, whatever it might be, I'm specifically looking at companies that in relation to the overall market have been beaten down because that's where you'll find your big winners, right? That's where you'll find your gains is, for instance, if we take a look at the chip sector, right, or industry. A few months back, I invested to a lot of my investments. I like to snap up about if I can like $1,000 worth of that share. That's kind of how I've like situated myself. So I put it was a little bit less. I think it was like 950 something like that into Intel. And the reason why I did that is because if you take a look at Intel in relation to AMD, in relation to NVIDIA, in relation to Qualcomm, in relation to Marvel, in relation to Micron, TSM, it's the one that has lost. It's been on a bad run. It's been beaten down. But at that time, there were lots of one they were getting to transition into a new CEO. So the CEO that everyone hated, that everyone thought, hey, you're running this company into the ground. They were getting rid of him, bringing in a new CEO. In addition to that, at that point, our current administration was really heavily focused on saying, we're going to bring the chip production industry to America. We want to see these being produced here. We don't want to see them being produced abroad, or we want to limit the production abroad. So that's when we started to get those conversations. I think Mitch and the group had posted something along the lines of talks of NVIDIA increasing production here in the States or something along those lines. So in my mind, I'm like, what's the biggest production opportunity in the US? It's Intel. When you take a look at what Intel has been as a company historically, it hasn't been the fact that they're innovative with their chips. It has always been the production side of things. They have the largest production, or at that time they had the largest production facilities or the largest ability to produce at the quickest, at the largest rate. Now it's Micron. Micron has heavily invested over $1 billion into their production side of things. So that's why you see a lot of companies partnering with Micron and TSM. Currently, those are the two biggest production based companies. It used to be Intel. So when I hear those things, I'm like, well, there probably is some sort of opportunity in Intel. I got in right around like the $18 mark. We saw a pop to about like 21, 22, got to take some profits. It got slammed back down, right? So it doesn't always happen right away, but that's a company that I potentially see an investment over a 10-year time frame.
Mm.
Right. And I say this because when I'm looking at my own long-term investments, I'm not looking to enter shares for a month, a week or so. I'm looking to enter shares for a year, 2 years, 5 years, 10 years. Ultimately, it is a 10-year plan based off of market conditions. Yes, I sold off some at the beginning of the year because I saw the opportunity to take profits, hold that cash, and then reposition myself again once I saw an opportunity to snap up more shares than what I was currently holding. So I don't know if that answers your question, but that's what I would be more interested in is looking at all of the individual sectors, analyzing what sectors are getting a rotation, and more importantly, which ones are the lagging companies within the sectors that we're seeing strength in.
Got it.
Yeah, that's a great and very valuable question. As we start to wrap things up, I definitely want to make sure that we're able to cover, at a general sense, monetary policy and fiscal policy, because this is where we start to see what the Fed is doing in relation to these reports, right? And it's good for us to understand what are these different policy changes, or to what extent do they affect things. Monetary policy specifically is in relation to the Federal Reserve's role. This is what the Fed does when you're talking about Jerome Powell and the Fed as a whole. It's looking into so who controls inflation and borrowing costs, right? It's the Fed, right? That mitigates or controls the inflation and the cost of borrowing money. And that's where monetary policy comes in. This is what the Fed has a say in, or the things that they do, it directly affects inflation control and the cost of borrowing money. So interest rates, right? That's what we're referring to when we say interest rates. It's the cost of borrowing money. So it affects your home purchasing ability, right? Because it affects the interest rates of buying a home, getting a mortgage. It affects the cost of credit. So Fed's main tools are adjusting interest rates through the Fed funds rate cuts or increases, buying and selling government bonds. We touched on this about a week or so ago when we talk about the flow of money. This is when the Fed is buying or selling government bonds, it's what the term of it, the technical term is quantitative easing or quantitative tightening. So when you hear that term being put out there in the media, in reports, articles that you might be reading, it's referring to bond selling, government bond selling or buying. That's what quantitative easing is, or quantitative tightening. When inflation is too high, what does the Fed do when it comes to rates? So if consumer goods, if prices are too high, how do we lower that? Because what do you want to do? If prices are too high,
Oh, increase
you
the amount
want,
of spend.
yeah. So so if inflation is high, we talked about this earlier, you want consumers to spend less, right? So the only way for prices to go down is for consumers to spend less. Consumers spend less if the overall sentiment, if the trust, if the confidence isn't there. What builds into that confidence? Things like unemployment rates. So in order for all of that to trickle down into those things we talked about, the Fed increases rates. So they make it more expensive to use your credit card, to get mortgages, to get car loans. They increase the rates. So that is an incentive not to buy, right? It's an incentive for you to hold off because you're saying this is way too expensive. I'm not going to make that purchase. So that's why they increase rates. In the inverse, they'll decrease rates if we're too low. Um, so making credit more expensive slows down spending, but it also makes it harder for businesses to borrow and to expand. So that's where you see it both on the consumer side of things and on the business side of things.
You have a lot of local businesses and smaller companies and stuff shutting down like crazy, especially
Yep.
in my town.
Oh yeah.
It
It's
only
so
takes like one natural disaster or one thing. We had a flood here, and so yeah, it just takes one thing, and then they're out.
that's the really the at least on my end, that's where like the heartache is in seeing these things play out, is that there's so much potential out there, but it all ends up affecting us on the smaller, us that are seeing on the smaller end, right? Because, like Mitch said, a lot of the locally owned, individual owned businesses and companies, they're the ones that can't live out that sort of contraction or that sort of recession, or if a natural disaster happens, we're the ones that don't get that help, where the bigger companies are able to mitigate it to some extent. And this also leads or plays a role in fiscal policy. So monetary policy is the Fed, right? We do have to understand, or I hope that we understand, that the Fed is separate from the government. The Fed, it's its own entity. It has nothing to do with government. They play alongside each other, but it has nothing to do with government itself. The government doesn't technically control the Fed. Yes, the administration can appoint the Fed chair, but it doesn't mean that that the government is necessarily telling the Fed what to do, because the Fed acts in its own interest. It really, and even beyond the government interest, the individual interest, the Fed, it's its own entity. The way that I look at it, it's kind of like the Vatican. right? Where it's its own power. So that
Exactly.
it's very interesting, and I won't get into that so much, but maybe that's a conversation we can have at another time, or with different conversation, because it spirals into something bigger within international government. But that's really how I look at it. The Fed is very much so like the Vatican. So that's an interesting conversation. But when you take a look at fiscal policy, it's the government spending power. That's Congress and the president using taxes and spending to manage economic growth. So, how do they do this? The expansionary fiscal policy can stimulate the economy through things like tax cuts, right, on a personal, like personal income tax, business tax. It can be done through stimulus checks, like we did for the relief payments during COVID closures, during natural disasters. Sometimes they'll send some stimulus. Obviously, it's not enough and it's very minimal. But that definitely plays a role in that sort of development and overall government investment. And that's something that I really wanted to bring up today and make sure that we cover before we wrap up this session, because, well, what's one of the biggest things? Do you all remember having heard some of these things, or when it comes to government investment, what's something that the current administration wants to do?
Defense.
Yes, but how do they want to do that? If you think about like where they want to invest, what has been proposed?
The Golden Dome is what I can think of.
Getting closer, but how do you do that? How do you diversify yourself in that way, and how do you strengthen government itself and the power, the money that it holds? Think of the Middle East.
I thought about oil.
To an extent, but it's not necessarily oil. How is it managed? What manages the oil and Middle East investments? I'm almost certain you know it. Their sovereign wealth fund.
So royalties.
Yeah, so you know how like Saudi Arabia and these different countries out there, they have their own wealth funds, their sovereign wealth funds. So what that means is that it's literally all of the government money, like where their wealth is, and they use that to buy up companies, to buy organizations. You know how what's it called? I forget, but it was that golf league that's owned by the sovereign wealth fund. I think it's the Saudis specifically. I don't know if you all are into golf. I'm not so much, but this was something that, like, through just like the market and stuff, became of interest to me. I forget what it's called. But there, and for instance, if you're a football or soccer fan, right? A lot of these sovereign wealth funds, they own professional teams, right? Whether it's PSG, the biggest team in Paris, that's owned by a Middle East sovereign wealth fund. If you take a look at England, Manchester City, that's owned by a wealth fund. If you take a look at
So
shoot,
it's just almost really any investment in like foreign, I guess, financial assets.
yes, it's both local and foreign, but it gives you the opportunity to determine or to dictate how that money is being invested.
Gotcha.
And
Okay,
then
got it.
that, yeah, and then that money is going back directly to that pool, that fund. So the government has a lot more power. Right now, there's a lot of checks and balances in how the government can invest and where they put that money in, because to an extent, we hold or should hold a lot of that power and that say, right? So you know how and this is more on like a minuscule scale, but you know how during election periods and things like that, we vote to determine whether the government can issue more bonds. And for instance, like at the state or local level, have you ever seen on your ballots things where you have to vote for extra funding for your school system, extra funding to address water supply issues, to address all of these different things, right? So when you established a wealth fund like that, it skirts around a lot of those things. So you don't necessarily have to ask, hey, can we vote on spending this money like this? It's a sovereign wealth fund. So whoever's managing that is going to put the money wherever it is that they want the money to go to. So the goal for them, what they want to do is they want to mitigate or fight back against it because these wealth funds are coming into our own country and buying
Or
up our
they're taking away our customers.
yeah. Yeah,
Okay.
they're taking it away, or they're taking away our profits, not necessarily right. They're taking away the vehicle that brings in those customers and those profits. So what they fear is that at some point in time they're going to come in, they're going to own the NFL, they're going to own the MLB, right? They're going to own all of these different things. And where are we? We were slow to the game, right? So that's why they want to establish a sovereign wealth fund for the U.S. It wouldn't surprise me if we get that done. But then that just leads me to think about, well, at that point, if we're like, how is that going to look specifically within a democratic country?
It's like
Right?
Chinese
Because
chess.
right, because we're supposed to be a democracy, and the reason why the Middle East and these countries are able to operate the way that that they do is because they're not a democracy, right? They have royal families that rule over them. So what are we doing here? That's a big question that I have. And I don't have an answer to it, right? Because I don't know the ins
I
and
do.
outs of that plan. And it's just something that's very interesting to me and why I wanted to touch on that specific subject when it comes to government investing, specifically in the way that they're able to do that and the restrictions that they have and how that might look like moving forward. It's a very interesting conversation.
Yeah, I'm seeing that Norway, China, and UAE have the top three most funded.
Yeah, and that's what I was interested in developing a bigger understanding of, and how does this look like in those countries that do have some sort of government, not necessarily just a democracy, but a government where officials are elected, right? Like Norway and things like that. I haven't developed that full understanding yet, but that's something that I'm working towards because of the intent or what has been put out there by our current administration. And I mean, you're already doing things that kind of lead me to saying, well, it's going to be established, right? If you're saying that we're going to like renaming the Gulf of Mexico, right? And saying, hey, we're gonna take over these things, or the intent, or what was it? We wanted to buy, what was it, Greenland? Is that what we wanted to buy? Um,
Yeah.
right. So if the intent is to do things like that, it becomes a lot easier to do that when you have an established sovereign wealth fund. Yeah, pretty interesting times. But that's the extent of the what I had today for our conversation. I know that we covered a lot more things in depth, so I really encourage you to watch that lecture in depth and to come back to the Discord, to the group, and ask any sort of pending questions because we covered I would say a good like 50% to maybe like 75% of what the conversation entailed, but there are still additional or is still additional information in regards to things like yield curve, recession indicators, overall macroeconomics and market sentiment understanding. So all of that is in there. I definitely encourage you to dive into that. I am going to go ahead and stop the recording here. I hope that you all enjoy the conversation that we had today.